Today's topic is on construction loans. Again, kind of a subtopic here, and the question is, can I use my land as a down payment, toward my construction loan? And the short answer is yes. It sort of automatically gets considered, but that doesn't really answer the detailed questions that come up in the various situations. So I want to illustrate that with a couple of different scenarios here. In one here column here, we show where you've owned the land for a year or less than a year. And the second we show where you've owned it for more than a year. And we're going to illustrate the differences here. And so, what happens in a construction loan is construction loans operate rather than the traditional just loan to value. If you're going to buy a house, and let's say the lender says you have to put a minimum of 20% down, then the loan to value is 80%, right? It's the inverse of your down payment. It's the percentage of loan, $80,000, let's say on a $100,000 purchase, divided by the value. And that's traditional with an existing home. But with a construction loan, they operate on the lesser of loan to value or loan to cost. And so we'll illustrate that here in just a second. But even loan to cost can be somewhat of a misnomer. And so right now in this column one here, we're going to show you that here's a situation where we have a piece of land that's owned less than 1 year. Now I'm going to show you something that is actually it's a ridiculous illustration in one way, but it's an actual illustration in another way, and I'll explain that here. So let's say that you have land that cost $50,000, but it's worth $850,000, and here's why it's ridiculous. You've owned it for less than a year. Now, I wanted to use this illustration because it's an extreme point that illustrates what I want to, how I want to answer this question for you, but it actually reflects reality. I mean, I know of a property just like this. Now, it wasn't bought a year ago; it was bought 30 years ago for $50,000, and now that very land, they're tearing down houses for $850,000 for a lot to build in the same area. So you have a land cost here of $50, but the value is $850. And again, if this were really owned less than a year, you wouldn't see these ridiculous price increases. Typically, it'd be a very extreme situation. But here, because you've owned the land for less than a year, then the cost is going to be the actual cost. You don't get the greater value. You don't get market appreciation on your land because you've owned it for less than a year. So for this purpose, your actual cost is $50,000. The deemed cost for the construction loan is $50,000. And then let's say on top of that, you're going to build a house, and all your soft costs, your permits and your building and everything is going to be $500,000 on top of that. So all in, your deemed cost for this loan calculation is $550,000. Now, again, we're going to keep on this scenario here where this land is really worth $850 just as land, and then you put $500,000 on top of that of a construction build. So we're going to say it appraises for 1.5. Well, when they do a construction loan, they're going to give you the lower of loan to cost or loan to value. And so if they tell you they'll go to 80% on this construction loan, they're only going to lend you 80% of $550,000. And so note here, your land is included here. It's just included in cost, not at its current value, because you've owned it at less than a year. But it is included in there as a part of the base for calculating how much loan that they will give you. And in essence, that does contribute. Basically, you're using your land kind of as down payment or as part of your down payment, because it's part of the value of the house that's being considered when they're deciding how much they're going to lend on. Now, in this case, just to make it a little more interesting, I said, well, what if I owe $50,000 on the land? So in this scenario, the lender is going to say, look, we'll give you a loan to cost of $550,000 deemed cost. We'll lend you 80% of that. So the max loan amount is $440. Now, your very first draw on a construction loan, when you have land that's being built on that has debt on it, is going to be to pay off that debt. So they're going to take this $440,000 loan, they're going to take $50,000 and pay off whatever debt is on that land. So what you have left for construction in this scenario is $390,000. And of course, you need $500,000 to pay the builder. You already have the land. We paid off the debt, so now you kind of own the land free and clear. But you've got $390,000 left to cover this $500,000, and so you're $110,000 short. And this money has to be brought into the lender at closing. It's not like the lender will say, look, okay, we'll get started on this deal and we'll spend the $390, and then when we get to this point, you'll have to pay for the rest on your own. No, they're going to say, we want all this money up front at closing because we want to make sure there is enough money in the deal to complete this project. Because maybe you won't finish, maybe any number of things could happen. Now, let's look at the second scenario. We're going to be here. Let's say you own this land for more than a year. The land cost, and this is a situation I'm very familiar with. People I know, that the actual cost $50,000, but they've owned it a very long time, and it really is worth $850,000. So for purposes of this construction loan, the cost of this land is $850,000, even though the real cost is only $50,000. But they're going to give you credit for the value of that land because you've owned it for more than a year. And so now you've got your same soft costs. You're going to pay or construction and soft costs, $500,000. And so your deemed cost for this is going to be $1,350,000, which is the deemed cost of the land plus the building cost and soft cost. So 1,350, still going to appraise at 1.5. Now in this case, for purposes of calculating how much loan they're going to give you, they're going to base it off of 1.350 because that's the lower of the appraisal or the cost. Now, if the appraisal came in at 1.2, they would give you 80% of 1.2. But in this case, the max loan they'll give you is $1,080,000, and again, they'll take that $50,000 first draw, and so that leaves you $1,030,000. Now, of course, you're not going to borrow this much because this shows you that you've got well in excess of what you need, and so you would lower your loan. Your construction loan request by $530,000. You're really only going to borrow for whatever that number is. I'm not doing the math in my head right now, but you can see that you've got well in excess of everything that's needed. So in this case, you've used your land. In this case, you've used your land as down payment. Essentially, you have to bring zero money to the table because really, all you need to do is just change this loan amount to the exact amount you need to make this a zero, and they'll gladly lend you that because your loan to cost is well below what they would be willing to go because you've got all this equity in this land and you've used that equity as down payment here. So I hope that answers the question. Feel free to reach out to me with your particular questions, and like, subscribe, do all the good things, leave me great reviews for this video. Thanks so much.